All right, everyone. Welcome to this month's webinar on tax smart wealth planning, strategies for investors and families. Today, we're going to go high level on some tax planning strategies for W-2 employees, business owners, tax strategies for investment accounts and investing, and then also family wealth planning, gifting strategies inside of the family. So thank you everyone for joining. I am going to be co-hosting this with Kevin Newport, who is one of the financial advisors here at Ausperity Private Wealth. Kevin, thank you for joining. You just recently obtained a new designation. Why don't you talk us through that? And I think everyone listening will understand why you're on this webinar with me today.
Yeah, thanks everyone for joining today. Kevin Newbert, certified financial planner, and now a tax planning certified planner as well. Really just going along with where the industry is going and the tax focus being such a large component. After doing close to 5 years of tax returns, personally, I just thought a big focus on it. So just recently, attained the tax planning certified planner designation to add to the name here. So
beautiful.
Yeah, trying to use the knowledge of our clients here.
Great. Well, thanks for joining. I'm going to do a couple just keynotes here and some housekeeping items while maybe you share your screen so everyone can take us through this. So again, this is being recorded. We will be editing this and making the video available. In addition, this presentation deck that we put together has been approved for compliance. So we will be sending this out to the attendees after the webinar today. As I've said before on previous calls, feel free to utilize either the chat feature or the Q&A feature. I will try to be monitoring that. We're happy to take questions as they go live. We will hopefully be able to answer those on the fly. So I think it's a more dynamic and engaging webinar if we do get questions as we're working our way through this. There might be some questions that we do not hit on that might be a little bit more specific and one-on-one. So if you do raise a question, we don't get to it on this webinar, we will be getting back to you on a one-on-one basis. So encourage you to use the chat feature or the Q&A. With that, Kevin, I think we'll kind of kickstart the discussion today.
Sure. Well, most people come to Ausperity, they typically come with 3 plans is a common thing that we see, and where they think they are, where they actually are, and where they want to be. And again, it's a really important piece for us is getting the most recent tax returns, doing tax forecasting for our clients. Obviously, we did this webinar timely with April around the corner here. People are getting all their tax forms together, having meetings with their tax advisors. A lot of people start to do the planning, or they're having the conversation with the accountant now, but saying all these things they wish they did in the year prior. So what we want to make sure our clients are doing is having a plan for 2026 as we're going throughout the year versus, talking in March about the year prior. So again, we're reading the 1040s, going through them, summarizing, tax returns for our clients and looking for opportunities for both this year and also looking in the future years as well.
Right. Super. Thanks, Kevin. So as we get through to the next slide here, the 3 pillars of tax planning, many times you're going to be looking to reduce. We don't want to pay more taxes, right? The goal is to pay less taxes. So where are there opportunities for our clients to lower their taxable income? Where is it beneficial to delay taxes? So the more you can kind of stiff arm the IRS, the more your own wealth can be growing and compounding and growing the overall net worth. So we'll talk through some strategies where it might make sense to push a tax liability into the future, allowing your wealth to continue to grow and compound to a greater degree. And then also maybe shifting income, whether that's allocating income to lower tax bracket family members, or even, again, shifting income to be hit in future years where you might be in a lower tax environment. The whole point of this is tax planning. You want to structure a plan for taxes and not just be reactive, but instead take the approach and be a little bit more proactive. So with that, as I said before, we're going to start off with some strategies for W-2 employees as we kind of look at different opportunities. Before I start that, Kevin, you have one other slide that I know you slipped under the radar here this morning, but it's a great one. So take us through just the differences between a marginal tax rate and an effective tax rate, because I think this is a common misconception for many individuals.
Yeah, exactly, Rory. I mean, it's a lot of conversations where people say, well, I'm okay making $200,000 because I don't want to get taxed to the next bracket where all my money's then going to be taxed at 32%. So it's just a misnomer. A lot of the times it's an effective tiered rate. So again, we're playing the tax game to our advantage. And then when we're looking at shifting assets, to later years, the concept of that is because if you have a big liquidity event, for example, in 1 year, after a certain threshold, all your dollars are getting then taxed at that 32, 35, 37%. So again, when you push it out a few years, you can start to effectively have certain dollars at that 10, 12, 22%. Again, we want to be mindful of, what your true rate is. So again, we're looking at both your marginal rate, what tax bracket you're now hitting, but also what is your effective rate on your income for that year. So again, it's something to be mindful of. We're thinking through there's a difference, right? We just want to make sure people are aware of your effective rate and your marginal rate are different things.
Yes, and the marginal rate really should be what's driving most of the planning. There are some massive jumps. Look at the tax rates there. You take a 12% rate, the next rate increase is at 22%. So that's the single largest jump in the tax code is when your income leaves the 12% bracket and then all new income is taxed at 22%. So many times that's a key planning item. We look for Roth conversions. Where can we leverage and utilize that 12% bracket? The next largest jump is from 24 to 32%, which can be very significant. That's an 8% increase. So when we're looking for opportunities to maybe increase taxes, to do Roth conversions, because there's going to be future income and large income down the road, we're really looking at those marginal tax rates. Super. So great slide, Kevin. Thanks for adding that in here. Let's transition into W-2 employee strategies. So right away, the common ones, the 401k, 403b is their preferred source for employees in terms of how they're saving for retirement. You can make pre-tax contributions, Roth contributions, or a combination of the two. The limits have been increased for 2026. Now it's $24,500 as the limit with an $8,000 additional catch-up. We also have flexible savings accounts, which could be an added benefit. We keep in mind for flex savings accounts, this is a use it or lose it, but you're utilizing pre-tax dollars to pay for certain expenses. Also, many times there's the employee stock purchase plans that companies allow you to purchase your own company stock at a discount. That could be very useful. Kevin, why don't you take us through the HSAs and maybe hit on deferred comp, and I'll kind of finish with mega backdoor Roth strategies if applicable.
Sure. Yeah. So HSA is something, people really try to take advantage of, especially our clients, because the triple tax benefit is the concept, right? So you're getting the deduction on your dollars and then they're going to go tax free. And then when you withdraw the money later on in life, it will be tax free. Again, on that is if it's used for medical expenses. If you don't use it for medical expenses, it's penalized at 20%. So again, that's one piece. The other big thing that I see clients missing out on what the plan actually is versus what they want is people forget you need to invest the HSA. So a lot of people have this HSA account they're contributing for the last 10 years and saying, but this account hasn't grown. So, one of the things we're doing, making sure for our clients is truly investing that account too, to get the tax-free growth and get the benefit of it as well. Deferred comp, same concept of delaying the dollars later. It's another thing where deferred comp is using a portion of your income and delaying it to later on. Because let's say your income is $400,000, you have $100,000 go to deferred comp, you put that in a separate investment account. And then when you're not making what for a lot of executives, the most income they've ever made right now, those future years, maybe if you retire 62 before Social Security starts hitting, pensions, other income, you can defer that. And again, for later years. So it's again, a tax planning opportunity that we look at for clients on how much makes sense to be deferring in your compensation wise.
Yes, I think corporate employees should really be aware of all of the different opportunities that company is providing. Do you have access to a flex savings account? Should you be utilizing it? Should you be participating in a high deductible plan? Well, that unlocks the opportunity to then invest into the HSA. How are you taking advantage of the 401k plan? Is there a stock purchase plan? So there's a lot. I think once again, that necessitates the need to have a plan and a proactive plan for how you can invest your dollars in the most efficient way. How do you reduce taxes? Well, again, as Kevin mentioned, the deferred compensation program might be more beneficial for someone who's in a higher tax bracket now, but might be closer to retirement. The deferred comp plan may not be as beneficial for someone in their 30s or 40s because the triggering event to start receiving that deferred comp income is going to be separation from service or is going to be retirement. That could be very far down the road. We've had some clients push back on the amount of deferred comp that they were previously doing before they engaged in working with us, just based on their specific financial plan and the restrictions involved with deferred comp. But we've also had a lot of clients start leveraging the deferred compensation that their employer was allowing as they're getting closer towards retirement, something that many of them didn't even know was available to them or truly didn't understand it. So this is complex stuff, and a lot of the companies are not providing the education, which is where we step in to try to analyze, well, what's available to you? How do we utilize them most effectively? The mega backdoor Roth is an item that I think every corporate employee should at least revisit on a yearly basis to see if their plan allows it. And just because their plan didn't allow the mega backdoor Roth 3 years ago doesn't mean that they could have changed the plan provisions to allow for that. The whole mega backdoor Roth is a way for you to supercharge your retirement by putting after-tax dollars into the 401k plan that then get immediately converted and rolled over into Roth. And the benefits of Roth, we've done this on future webinars, is all future growth is going to be tax-free so long as a certain number of requirements are met. I call it a retirement game changer. If you have the cash flow to put more than the $23,500 into your 401k plan, then the mega backdoor Roth, if available, could be a massive win for you as an employee. Thanks, Kevin. We'll kick on to the next slide here. Employee compensation tax planning. So this is as it relates to stock. You're working for a company that is a publicly traded company. Many times a lot of the bonuses are going to flow through in the form of stock. That's known as a restricted stock unit. So the key item to be aware of there is that it's going to be taxed as ordinary income. Kevin, why don't you talk a little bit more about RSUs and what we often see as a unknown side effect as it relates to tax associated with restricted stock units?
Yeah, so one of the big things with RSUs, and we have a lot of clients who are receiving this, is it's going to be effectively taxed at 22% withholding. And some of our clients, again, are getting taxed at higher rates than that. So when April comes of each year, they're paying this big tax bill. So there's a few different items that you can be thinking about. If the stock does really well, typically clients are okay, or they have the additional dollars to spend to pay the tax bill. But there's years where that RSU, because it's taxed as ordinary income, sometimes the stock, has a significant drop in a certain year, and now you're still paying tax on maybe it was $100,000 in RSUs you got, but now that stock has went down 30-40%. Now it's $60,000, essentially your effective amount, but you're still paying tax on $100,000 of income. Right. So again, it's something to be thinking about is what to be doing if you should be making quarterly tax payments, or there's way you can have your W-4 to essentially withhold additional dollars. But again, it's conversations we're having in advance versus, again, because you don't want to also at the same time overpay the IRS, because essentially if you're doing that, you're missing out on additional dollars you can invest, live on an annual basis. So again, it's measuring what your tax forecast is on an annual basis.
What I always kind of utilize to kind of help clients understand restricted stock units is they're really cash bonuses just in the form of stock. The company is giving you, say, $50,000 worth of shares. It's taxed to you just like getting $50,000 of a cash bonus. However, you're given the stock, it's on you to then diversify the position. And many individuals I see either do one of two things. They sell it immediately, convert it to cash, and then utilize those funds, or more often than not, they do nothing, and the stock continues to pile up. That could be extremely lucrative and beneficial if the stock's doing well, but it's very difficult for single stocks to outperform the market on a consistent basis. So many times that stock can underperform, and just to Kevin's point, you've received the shares. Had you sold them and then maybe diversified, that could have been a better risk versus return strategy for you. So the key consideration is restricted stock units are taxed as income. You're then given that stock, and your cost basis is the day the stock vested. From there, the stock can go up and it can go down. The next sale is either going to trigger a capital loss or a capital gain. We'll get more into capital gains and losses and potential strategies later. What about employee stock purchase plans? What can you talk to us in the audience about employee stock purchase plans, and when should employees consider that?
Really what the appeal is, especially when someone first joins a company, is they're like, well, I get every single position 15% off. Essentially, if you're buying the stock at a 15% discount, the attractive piece of that is you are dollar cost averaging, and that means you know, on your bi-weekly paycheck that you are buying the stock at different price points, which is again a benefit. But what people start to do is they're getting the RSUs, they're getting employee stock purchase plans. Now they're at the company for 10, 15 years. Now 50% of their wealth is in one concentrated stock. So on a month-to-month basis, you know, their total net worth is now heavily concentrated in one position. So again, it's a good strategy, but also one to be mindful of how much you're doing and what that starts to look like over time. At what point is it beneficial if the stock goes on a run to potentially sell some of that employee stock purchase plan that you did well on for the last few years buying it, and start to look to diversify and have more predictable returns and overall diversified portfolio.
So the key point here with equity compensation is be aware of what tax impact those shares are having on you in the restricted stock side, but then also be aware of the concentration. Employee stock purchase plan, it's amazing. You can buy the stock at a 15% discount. Everybody loves buying something on sale. Just be careful of how much you're going to hold of that company stock and what risk you're placing now with the company being your employer, but then also potentially being your largest position. Where we also see a lot of over-concentration sneak up on our clients is going to be with stock options. And we can get very much into the weeds on stock options. I want to keep it high level here. What's more uncommon, which is typically going to be for companies that are a little bit younger in nature, more in the startup phase, or they just recently went public, would be incentive stock options. These are really, really special, but we've seen a ton of mistakes by employees that receive an incentive stock option, they exercise it, and then they don't wait that 1 year period, they end up selling it. By waiting that 1 year period after you exercise the position, you can turn the tax from an ordinary income tax, which, back to Kevin's slides, those marginal rates, the different tax brackets, you can turn that tax into a capital gain tax, saving you upwards of 10% in taxes on that transaction. So the incentive stock options really need to be handled with care, with strategy, and a definitive approach to utilizing those. They're not as common, but wow, they can be very lucrative, and they can be much more advantageous for the employee from a tax perspective if it's handled appropriately. Non-qualified stock options are always going to be taxed as income. So you want to be aware. Typically, there's a 10-year period where you have the ability to exercise them, and then they end, they expire, they go away. The grant price versus the price you exercise at, that spread is always going to be taxed as income. So you want to be cognizant of, okay, what is this income doing to the other income that I am experiencing over the course of the year? Does this push me into a higher tax bracket? Is there a strategy that I can counter the taxes associated with this stock option exercise? Essentially, if it's in the money, so to speak, you're granted the shares at 10 and it's trading at 15, you really have a lottery ticket, and it's your choice to cash it in. At what point do you do so? Well, that requires some thoughtful planning. You want to do it prior to expiration because this is an increase. This is obviously a option that has worked in your favor. Now I can buy shares for $10 even though it's trading at 15. We walk clients through this all the time, but many times there's not a lot of education surrounding these stock options. Some clients have the choice, depending upon the company they work for. Do I take my compensation from an equity comp perspective in restricted stock units or stock options, or a combination of the two? This is another opportunity to look at the overall big picture financial plan and help with that discussion. Thanks, Kevin, for this slide. As we round out, what we created here is a great checklist that I think every W-2 employee should look for. So just going down very quickly, I'll take the left side, Kevin, you take the right side. As a W-2 employee, take a look at whether you can maximize the 401k contributions. This is going to be your largest income reduction opportunity for most individuals. Review your holdings, your W-4, as Kevin alluded to. You want to avoid large refunds. Even though it's nice to kind of get money back from the IRS, keep in mind that's money that could have been growing and compounding for you. Take the money off the IRS and the government's balance sheet, put it on your balance sheet. If you have strong cash flow, look to go beyond the 401k from a saving perspective and potentially exercise execute a backdoor Roth IRA if your income is exceeding the contribution limits. Consider bunching charitable deductions or using a donor advised fund as a way to lower your taxable income if your taxes are going up or if your income's going up because of a restricted stock vest or a stock option exercise. Here we're playing a little bit of offense and defense. And then lastly, review your employer non-qualified deferred comp plan if this is applicable to you and also if it makes sense. Kevin, why don't you take the final 5 to round us up before we move on to some business owner strategies?
Yeah, so again, open and funding an HSA if it's eligible, making sure you have a high deductible plan that you are eligible to be doing it, evaluating how much you should be doing in the Roth bucket versus the traditional side based on where your income is today and your future income. If you're younger, typically it makes a lot more sense to be putting stuff in dollars into a Roth. But again, it's sizing up the amounts that you're doing and also understanding that the employer side is going to be in that pre-tax bucket. Even if you're doing a Roth 401k, what they might be matching is still going to be in that pre-tax bucket. Equity comp, again, when stocks vest throughout the year. RSUs, they might do quarterly, biannual, when they vest, and then having a plan in place. SALT, meaning state and local tax, that went from $10,000 deduction. Now it's up to 40 with the One Big Beautiful Bill Act. Understanding if you're itemizing versus taking the standard deduction, and having that team in place, having your CPA and your financial advisor coordinating throughout the year, again, versus waiting weeks before in April. So to get into the business owner strategies, to start, we were talking on entity structure and tax implications.
Yeah, Kevin, thanks for that. So with this, I think the big takeaway is involve your CFP, but then also a CPA, certified public accountant. So what you want to do is evaluate and have a huddle with your tax advisor and your CPA. Also maybe evaluate whether you're utilizing a CPA that has the skill set that you need as a business owner. We've seen some clients kind of outgrow their tax advisor and be in need of someone who specializes in working with business owners and the tax reduction strategies there. One of the key areas that you want to focus on first is what's the right structure, whether that's a sole proprietor, which is beneficial because it's simple and it comes at low cost. One of the downfalls is that all the income is subject to tax. You can look for the LLC, which is flexible, and now you can limit the liability associated with the structure and the entity, but the same thing, you're looking at the same tax associated without the S-Corp filing. So what are we seeing more of? We're seeing more S-Corps. Kevin, why don't you talk about why we're seeing maybe a little bit more S-Corps recently and how they can be beneficial entities for some of the business owners that might be listening today?
Yeah, for the business owners here, a lot of times you see the reason for the S-Corp is you can have what needs to be reasonable salary of what you need to pay yourself, and then the additional dollars as business distributions, you can avoid payroll tax, essentially, of getting taxed at that self-employment income, again, versus just getting taxed at your federal and then your state level. You're allowing income to get taxed at essentially an effective lower rate. Again, that's the key piece here, is understanding what strategy makes the most sense for the business, as well as effectively what is paid to you on a post-tax basis. It's not always about how much you make, it's about how much you keep. That's the big focus for us here.
Yep, and C Corps we're not seeing as much of, at least with some of the work we've been doing here recently. There is, I know, Kevin, you've talked about this, if there's a potential sale, there's been some recommendations from CPAs to move to C Corp. Why don't you talk through where that might come into play, just high level?
Yeah, it's thinking through, do you want to get what is essentially the goal of the business? If the business is essentially have a sale, it sometimes makes sense to pay more taxes in the C Corp because you are going to get taxed at 21%, and then again at the income level of on the personal side. But there's qualified small business stock, which is something we've been talking on with some clients right now on, if you're going to sell the business in 5+ years, there's ways to then flip, and you can essentially avoid a significant amount of capital gains on a sale down the line. 3 years in, 60%, 4 years after essentially flipping maybe potentially to a C Corp, avoiding 80% up to $15 million of capital gains. After 5 years, 100% avoiding $15 million. So again, it's a significant, conversation to be having on and taking very serious. If understanding what is the goals, objectives of the business.
I think that's a key point, Kevin. What is the goal and what's the end game? If the business is looking at a sale and there's a real possibility for a sale in a couple of years, evaluating the entity structure. In your case, that could save millions of dollars down the line. So work with your accountant, work with your tax advisor on our team in terms of, okay, what's the goal of the business? What are the intentions? If there's an upcoming sale, let's evaluate the structure and see if there's pros and cons, potentially changing that structure to set yourself up for lower taxes when that sale occurs. Super. How do we put money away if you are a business owner? So what's very common, or what we see more often, is going to be the SEP IRA and the solo 401k. Kevin, just high level, SEP IRA, some pros associated with utilizing a SEP to defer income and lower your ordinary income.
What I think, again, with a SEP that typically makes sense is someone who's maybe, starting their simple, small team. Maybe you outsource some of your not full-time employees. Because the thing is, if you start to have employees that are consistently working for you, just to be, again, mindful of uneducated, because the information's out there with Google and chat these days, but it's execution side and understanding the pros and cons in every decision. Because again, the information's out there, but there's a lot of information at once. So again, you can do 25% up to $72,000 to contribute to a SEP, but it's being mindful of the amount that you do. You might have to potentially, pay that out to your employees as well. Again, that might be a positive thing. It's a way to attract good talent to your firm, but at the same time, you have to understand you are getting a deduction, but that what makes sense for you, because that could be an additional cost to the business. So it's being educated on that decision that you're making with the SEP.
I think that's great. And the good news with the SEP, or the pro there, is that it is going to be very low cost. The SEP IRA you can set up with pretty much any financial institution, start utilizing them, meeting those deferrals, and probably being able to structure that and handle that with a strong accountant. The solo 401k is where we're seeing a little bit more for the business owners that are now ramping up. The income's substantial. They're looking to make contributions into something beyond the $24,500, but possibly because they are going to be the sole operator, they're going to meet the testing requirements, and are typically able to add the mega backdoor Roth feature. So this is where the individual and the owner can make a pre-tax contribution to lower taxable income, but then can feed additional after-tax dollars into the plan that then gets rolled over into Roth for future tax-free growth. This is, again, going to be best for self-employed individuals. You don't want to have other W-2 employees. That will ultimately mess with the testing requirements, and you certainly can't do a solo 401k if you have a big workforce. So the solo 401k we're seeing for a lot of individuals that have 1099s, or they're a sole operator taking K1 distributions. You're doing those huddles and saying, okay, I have solo 401k, and I have a SEP IRA. Those are the two most common that we're looking at for those individuals, and we're going to weigh those pros and cons associated with those. So many times we see clients and business owners start with the SEP IRA, and then they graduate towards that solo 401k because they want to add a couple of additional features, bells, whistles, or take advantage of the mega backdoor Roth. What we're not seeing so much of is the simple IRA. And I think it's just the evolution of the industry and the evolution of all of these different entities and structures that can be utilized. The simple IRA is a limit of only $17,000. So again, it's easy, it's simple per the term, free to set up. But we're seeing more of that tax deferral and more of that tax reduction be felt by utilizing a SEP IRA or a solo 401k. Kevin, curious if I missed anything. Otherwise, why don't you lead into the defined benefit plan and who that might be suitable for?
I think you touched on it perfectly with, again, it's understanding what makes the most sense for you. Defined benefit plan, it's a lot times makes a lot of more sense for high income earners and 50 plus, sometimes in their 60s. The limits, 70,000, 17,000 for a simple, you're able to put in up to $290,000 per year for a defined benefit plan. Again, that's a significant amount to be deferring out for later on. So again, it's something to be mindful of, but I just wanted to at least have that in here for people to be aware of. Once you hit this, because it's saying, okay, I can do my 72,000, my solo 401k, and then I'm going to do my backdoor Roth, but it's like, what else is out there? Again, we want to make sure you're aware of the different strategies and retirement plan setups for for you.
Yeah, I think it's interesting to know that most people associate the 401k and they immediately think of that 24,500 as the absolute max. And then you have maybe the catch up if you're over age 50, you can put an additional $8,000 in. Well, the 401k really allows $72,000. What gets added to your deferral could be the company match, but it also could be your own post-tax or after-tax contributions that go in. Beyond that, you're not done. If you're one of the benefits of being a business owner in this country is that you're able to take advantage of certain structures and go beyond the scope of that 72,000. Adding in that defined benefit plan could be the solution for you, but it's ways that certain single business owners can put away significant amounts of funds and significantly lower taxes. So I appreciate you touching base on that, Kevin. Okay, next we're going to lead into the investments. So we're now investing wealth. We're utilizing 401ks. We're utilizing non-retirement investments like brokerage accounts. You put together this slide, so I have to give you the credit for piecing this together. Why don't you talk us through what this slide entails, because I think it's excellent.
One of the things I think there's benefit in this, again, because there's so many different accounts, I think clients start to have their checking account, their brokerage account, their 401k, maybe some 529 plans for their kids. There starts to be a lot of different accounts in a lot of different places. And it's like, after I hit my 401k max, I do my backdoor, like what else am I supposed to do? And what's like the true benefit of doing one versus the other? So the concept is deductible, 401k, doing an IRA, traditional IRA. If you don't have the eligibility of doing a 401k, you can get those dollars to be deductible. You're going to defer the tax, but later on, you're going to pay taxable income. Savings, investing in stocks, bonds, not deductible. It's after tax dollars, and that's why it's not deductible. You open a brokerage account, you put dollars in that, buy a couple ETFs, mutual funds, potentially individual stocks. You're buying some real estate. You're paying the income, dividends on an annual basis. But there's no limits. You can put as much into these accounts as essentially feasible for you, but there's a cost basis. If you put $100,000 and now it's $200,000, that's going to be potentially taxed at capital gains or short-term capital gains, which we'll get into in a second. But again, it's that $100,000 that you made isn't to be deferred. And again, on the dividends, interest, if you have CDs, bonds in your portfolio that are yielding 5-6%, you're going to be paying the tax on an annual basis. The benefit of putting that in a 401k and deferred later on is you're letting those dollars compound. You aren't taking from the portfolio or from your checking account and having to pay that tax each year. You're letting compound interest do its thing and be beneficial. So again, to get to the later on is the Roth IRA, Roth 401k, 529 plans, HSAs, where it's not deductible or deferring, but it could be tax-free later on. With the footnote I put on the bottom there is there's typically caveats in all these things. Roth IRA, you might have to wait till after 59 and a half. You can take out $10,000 for, your first home purchase, and there's a couple of different provisions within that, but for the most part, it's a later on strategy. If it's an investment that you want for, maybe in your 30s or 40s and you want the money in a few years, you don't want to put every dollar in a Roth because you need that money in a couple of years. So again, it's the planning that gets involved in this. There's a lot of different nuances at play. This is kind of like a cheat sheet that I built that I just think is, you want to see it all in one place.
Yeah. There's benefits for its tax strategy. When should I be reducing my taxes or my taxable income? It's when I'm in a high income year. When do I might want to push income to a future year? Again, if I'm in a lower income right now, or I'm in a higher income right now, and in the future my taxes are going to drop and then go up again. We see this a lot with individuals that are working, they're hitting those peak earning years, then they retire. And if they retire before 75 and they have minimum distributions, there's going to be low income years. Those are those gap years. That's where it might make sense to accelerate taxes by doing Roth conversions so that you're not hit with massive income taxes from age 75 and beyond that gets triggered with RMDs. I think Roths are unbelievably special. What we want to try to do is strategize, how do we get assets into Roth and when is it most effective to do so? Because the benefits, if you can meet those requirements, is to be able to take withdrawals completely tax-free. So this chart is a great cheat sheet. Not everything is going to be easy to implement and not everything you're going to be able to implement, but it's helpful to work through that. For non-retirement assets, where again, you're not letting the compounding take place inside a 401k or an IRA, where you can rebalance portfolios, where the income and interest is not taxed, instead it's deferred. Let's say we're investing non-retirement assets. There's a cash bonus, or you build up additional funds from cash flow. We then invest those funds. If we're selling those investments at a profit, that's going to trigger a gain. In short, a short-term gain is if you sell an investment for a profit that you've held for less than 1 year. It is then going to be taxed as ordinary income. That could be upwards of 37% federal, plus potential state income tax, and an additional 3.8% for additional Medicare, Social Security tax, etc. So on a $100,000 gain, you could be paying $37,000 in taxes. This is if you sell an asset that has appreciated in value that you've held for less than 1 year. Generally, you want to look to avoid creating short-term gains. Kevin, talk us through long-term capital gains.
Right. The long-term held more than 1 year, definitionally is what it means. But on an income basis, most investors are in that 15%. So between 95,000, and 590,000, 15%. Over that number is 20%, and then that net investment income is dollars. If you're married, is 250,000. But what that means too, just for 5 seconds, is over that number is then what is taxed an additional 3.8%. So if you have 300,000 in long-term cap gains, that net investment income tax is 50,000. So once you hit above that 250,000 is when that additional 3.8% hits. But again, it's sizing of what makes sense. If a position has a significant quick run up, it still might make sense to sell it short-term versus long-term. So it's thinking through this, because some people just want to hold it a year and 1 day just to get the tax benefit, but not take profits along the way. So that's, again, why you have an advisor team that you're talking through and having these conversations. It can be significant in the differences here.
The one thing is we also, in the next slide, is there's a number of strategies we've been leaning more into for our clients where we want to create positive returns in environments where the market's going up. But to Kevin's point, we might be looking to take those profits either inside of a year or because the client needs the funds. You're investing into the stock market, you retire, we're now on a withdrawal strategy. We're selling off investments. If those investments have appreciated in value, that's going to trigger a capital gain tax. One of the ways to reduce a capital gain is to offset the gain with a capital loss. So that is selling and realizing a loss on a position that you purchased. It's inevitable if you are diversifying the portfolio and you're diversifying your wealth, that you will have investments that don't always go up, and you might want to opportunistically sell some of those investments at a loss to then offset the capital gains from any sales of assets and investments that have gone up in value. What we've done previous webinars on are direct indexing strategies, where we're building basically the S&P 500 for clients. We might own 380 of the 500 stocks. Well, not all 380 stocks are going to go up in unison. Some of those stocks fluctuate and drop. One of the benefits and goals of the strategy is to get the same returns as the market while creating certain capital losses along the way on those shares and on those stocks that may not have appreciated in value. So it's a key strategy for us in utilizing for clients that either have upcoming liquidity events where we need to start creating capital losses to reduce that capital gain that might be triggered when there is a business sale, or there's the sale of an appreciated property, or there's the sale of a concentrated stock position. Tax loss harvesting is a key strategy that we evaluate throughout the course of the year, but get hyper-focused on, say, in November, when we evaluate, okay, due to rebalancing, due to clients taking withdrawals, what is the current state of their cap gain? And what's short-term, what's long-term? Is there anything in the portfolio that we might be able to rebalance and create that capital loss for? Some of those strategies, like the direct indexing, is we're intentionally trying to create those capital losses, because those capital losses also can reduce income. Kevin, why don't you talk about the $3,000 income reduction you can utilize with cap losses?
Yeah, so one of the big pieces with this again too is thinking and understanding all the different facets in the investment management world. Still have a position that has not done well. Maybe it's a $50,000 loss that you're taking. $3,000 per year can go directly against your ordinary income. The rest of that, the $47,000 will carry indefinitely. So you can utilize that for future years, create some losses now again for a future event later on, but they don't go away. So if it's, yes, there's $3,000 you can take in that singular year, you can offset it throughout the year of different cap gains that you might have taken, but up to $3,000 per year can effectively go against your ordinary income. And then from there, they're going to carry off indefinitely.
A key consideration that we have in here is something known as the wash sale rule. The IRS prohibits buying the same security within 30 days after you sell that security and take a loss. So you can't have a investment. Let's say you buy shares of Apple. Apple drops after 30 days. Apple drops 6 months after holding it. You can't sell your Apple, take that loss, and then buy it back to maintain the exposure. You need to wait over 30 days to book that loss. Otherwise, the repurchase is going to be known as a wash sale. Where that currently is not coming into play is in cryptocurrencies, not crypto ETFs, but actual Bitcoin. You actually don't have wash sale rules. So if you have some Bitcoin that you purchased and it's dropped in value, as Bitcoin struggled over the last 6 months or so, you can actually sell your Bitcoin, purchase it right back, and you're still able to book that loss. But that's a key consideration. You can't do that with ETFs, mutual funds, or individual stocks. So careful planning is going to be needed. So we're moving on to finalize the discussion today on estate and family planning, something that we haven't hit on so much. Just want to go over some key numbers. Kevin, why don't you walk us through some updates and changes to gifting strategies and estate overall for 2026?
Yeah. So one of the things is there's ordinary income tax, which we talked on. We talked on capital gains tax, and then there's estate tax. The estate tax number is pretty high right now at $15,000 for singular, up to $30 million for families. But you can gift $19,000 per year. Again, this is typically later on in life, to give to grandkids, to support in different facets to your kids and your grandkids as well, but you're able to give $19,000 on an annual basis that's not going to go against your $15 million. Now, this $15 million, 30 for a household, typically in the early 2000s was $1 million. So that number has then went up to 5 million, 8 million, has been continuously going up. And there was conversations for it to eventually offset and sunset and was going to go back down to 6 million. But essentially is using that today for the families that it's relevant for, because after the $30 million or $15 million for single households is taxed at 40%. So there's conversations like an IRA, for example. We have $1 million IRA, which is a subject to the 40% estate tax. So it's getting hit with 40% tax and then ordinary income again, then on the federal and the state level. So that $1 million starts to get eaten up by taxes. So again, it's pre-planning these conversations. So there's a lot of gifting strategies that are involved, and it's multi-layered, different conversations we're having. 529 plans, for example, you can fund up to 5 years of this number at once. So you can use that 38,000 times 5 on an annual basis, have that super fund it, and then let compound interest do its thing and grow to pay for that tuition payments. Also, this $19,000 or $15 million, if you pay this directly for tuition or medical bills, does not go towards it. Someone in your family has a big medical bill or tuition payment coming up. As long as you pay for that tuition payment directly to the university, that does not go against your federal exemption. So again, then there's a lot of different trust strategies, which we have to freeze dollars. I think that's probably for a one-on-one separate conversation for having those. But again, it's these conversations that you need to be having of if this, then that, and what makes sense for you, because you also don't want to overly gift. And then you got to make sure your cash flow makes sense for yourself as well.
Yeah, and these are federal. Certain states will have inheritance tax, certain states will have estate tax. So the key theme here is planning. What does my estate look like? What are the tax implications associated with it? Also, as we do financial planning for clients, we're projecting their wealth over the next 5, 20, 30, 40 years. As we're looking through those projections and we start seeing that this family might have wealth creep into that 15 single or $30 million joint family, the need for some of these gifting strategies becomes paramount to the family to avoid a 40% tax on any of those assets. And this is all subject to change. A new administration could change these limits. We could see that 15 million get cut in half. To Kevin's point, it was as low as $1 million in the early 2000s. So you need to plan for here and now, but you want to be aware of, okay, where's the puck headed and what strategies should we be thinking about and putting in place now so that we're keeping more of our own wealth, not as much as going towards the government in the form of taxes. Kevin, there's one also really neat key item that I don't think enough families really think about and can utilize as a beneficial tool when they're thinking about their estate. And that's the step up in basis. This could be applied to an appreciated stock. This also could be applied to real estate. Why don't you walk us through how that works and where it could find its way in planning for families as you start thinking about the next generation?
Exactly. And this is, us being in New Jersey, this is a big conversation for vacation homes, and the Avalon, Stone Harbors, that 40 years ago, these houses that were bought for a few $100,000 are now a few $1 million. To sell that is going to have a significant amount of taxes. But if you die with the property, you got to step up in basis. There's a lot of, inheritance that we're having these conversations of what makes sense, but that property or stock maybe that you bought here in this example of $50,000 is now worth $500,000. You then, if you inherit the stock and then sell the next day for $501,000, you're only paying tax on $1,000 versus $451,000. So that is a giant difference. But again, it's what makes sense. Sometimes where the stock, maybe you gift a portion of it to a grandchildren. You see yourself living another 10 plus years. Your grandkid might be in the 10% tax bracket then. So maybe you gift portions of that, they realize some gains, but it's thinking through it and having a plan around it. But again, this is something, it's a huge benefit for people to have as a step up in basis to create more family wealth for yourselves.
It is coming up in real estate, and a lot of our clients that are retired or baby boomers, they still have parents that are alive, and those parents might have their house as their largest asset. And the question is, what do we do with that house? Do we gift it now, or do we essentially keep the house? Because it might be a PA resident. And in Pennsylvania, there's an inheritance tax of 4.5% for assets that pass down to children. So our clients are talking about their mom and dad that have a house in Pennsylvania. It's been highly appreciated. The question is, does mom and dad sell the house to us now, or do they gift the house to us now? Where if they gift, that cost basis follows. The house was purchased for $100,000. It's now worth $900,000. If that gift is made, yes, that can now leave the estate of mom and dad. However, that cost basis follows. So that if our client sells the house for that $900,000, you're looking at a cap gain of $800,000. Otherwise, mom and dad continue to own the house. They pass away. It's inside of their estate. It's going to be taxed at 4.5%. But that step up in basis means that the children, yes, pay the inheritance tax, but now own that asset and can sell it without any capital gains. So many times the consideration is what's more beneficial for the family from a tax strategy. Are we gifting and utilizing this and gifting the property to a trust where the cost basis follows, or are we going to retain the ownership of it and then when there is a passing, the beneficiaries receive that asset, but receive that asset as of the price at death. So there's some key considerations. You might want to be pulling in other professionals, like a CPA or like an estate planning attorney. Just a couple things to keep in mind there. So as we round out the discussion here today, I know there was a lot, but we want to kind of go through different layers of tax planning as it relates to the corporate individual or the W-2 employee, the business owner, the investor, and then also the planning for families and generational wealth planning. We wanted to kind of finish with four key takeaways for you viewers to think about as you move on and try to implement this to keep more of your own wealth and try to be proactive with a planning perspective. So same thing, Kevin, I'm just going to read over the three on the left here. Start with your employer benefits, your 401k, HSA, FSA, the low-hanging fruit. If you're listening here and you have children that are now entering the workforce, try to help them, try to educate them to think of how are they going to utilize all of the different features that their company might be allowing them to take advantage of, whether it's those retirement plans or those health plans as well. Think about the Roth versus traditional decision. Am I going to do Roth 401k contributions or am I going to do pre-tax 401k contributions. What's more beneficial to me at this stage in my life? Where you hold your assets matters. So think about getting the different tax brackets correct. And then also what we just kind of keyed in on is appreciated assets. If you hold assets that are appreciated till death, there's a step up in basis. You might want to hold, not gift away those low basis positions or assets. Kevin?
Right, Rory. And one of the things too with tax loss harvesting, Rory went through the direct indexing strategy we utilize for clients as well. Another thing is don't let losses expire unrealized. That year, you have to essentially show the losses. Otherwise, those will expire in a sense. So another big piece too is everyone in this bull market that we've been having going on, everyone's forgetting that there are times where there's positions that go down, right? So one of the big things too is allowing to take those losses in the year if there is a passing. Again, this is a team sport in a sense, having your advisor, your CPA, your attorney, and being coordinated with each other. That's something we're really big at Ausperity of focusing on. And again, you want the dollars to compound. You want no unnecessary taxes to be paying. We want to either reduce, defer, shift. Think through it and what makes sense for you. Again, what we're focused on is how much goes in your pocket at the end of the day. I appreciate everyone coming today. I don't know if there's any questions.
Yeah, we did just get a last question, so I'll read it off and then work through answering it. So I'm 58 years old, retired on 12/31/2025. I'm covered under a high deductible retiree health plan until I turn 65. I want to confirm that I'm permitted to contribute $9,750 in 2026 to an HSA. Additionally, am I permitted to contribute to an FSA or as a retiree, or is it only applicable as an employer-sponsored plan? If the answer is yes, can I set up an FSA via Fidelity? So the final two questions, can a retiree contribute to an FSA? Generally, the answer to that question is no. It's usually going to need to be an employer-sponsored plan. And then Fidelity setting up the FSA, I also believe that answer is no. Usually the custodian, in this case this would be Fidelity, can't create the FSA. That usually gets set up through the employer plan. Kevin, off the cuff, I don't know if you have anything on the HSA contribution for 2026.
Yes, with you retiring on 12/31/2025, I think with Rory, to piggyback on that you need to have a plan that you're under to be, making that contribution.
Great, super. So appreciate the questions. We kind of hit the hour mark. Certainly feel free to reach out to us individually if you have one-off questions. Hopefully you have 2 or 3 takeaways from the discussion today that you can utilize in your own planning for taxes. Maybe you can share with a family member and you can consider to incorporate in 2026 strategy. We appreciate the time. We appreciate the questions and everyone joining here today. The goal here is let's be proactive in 2026 when it comes to taxes. I think the other note is there's a lot here. There's a lot that we could have gone really deep and into the weeds on. We wanted to keep it high level. But once again, the goal is to kind of have a plan and take a proactive approach to tax considerations and tax planning for the year. So with that, Kevin, appreciate your assistance here today on the webinar. Thanks for the prep and great stuff that we reviewed and highlighted for everyone who attended. So with that, enjoy the rest of the week and thank you for joining.